The difference between a high probability credit spread and a low probability one usually isn't the stock that you choose. It's the expiration and the strike prices you select. In many cases, retail traders get this wrong and they're left behind the 8 ball right away. In this video, I'm going to walk you through the exact framework that we use on all of our credit spreads to make sure we are in high probability trades on every position. My name is Mike Rixey. I'm one of the options instructors at NetPicks, and this strategy that I'm going to walk you through over the next few minutes has been a game changer in my own trading, and it's been so for a lot of our members as well. So many people get tied up in just buying calls and puts, and I'm not opposed to that. I'm okay buying options. The problem long term is you are limited to one way of making money. If you buy a call option, that stock has to move to the upside and it has to do so quickly. On the downside, if you buy a put, the stock has to move lower and it has to do so quickly. That's the only way you have of making money. If the market gets slow and choppy, if you're in more of an indecisive environment, the long options can struggle. That's why I believe every trader should have the credit spread as part of their options toolbox. It's such a game changer over time. So let's talk through how we pick the right expiration and the right strike prices to make sure we have the numbers in our favor. So let's start out with the expiration cycles. We lump our trades at NetPicks into 3 different baskets. We have our swing trades, our active trades, and our day trades. And you want to make sure the way that you structure your spreads matches up with your outlook for that given stock. It doesn't make a whole lot of sense if you have a big long-term outlook on a stock where you're expecting it to do something over the next 2-3 months, and then you place a trade using a 0 DTE option. That just doesn't match up. You want to make sure you have a very high confidence level that the stock is going to do what you want it to do in a specific time frame, and then the options match up with that outlook. So when we talk about a swing trade, oftentimes our swing trades are based off of either a 130-minute chart or a daily time frame, and we're using options that have between 20 and 40 days left to expiration. In many cases, we're in those positions anywhere from 6 to 20 days. Very common time frame for us. I go out 20 to 40 days in this case. I want to have a little bit of a cushion. Just in case that move doesn't happen in my favor right away, I've got some cushion. I can be more patient and let the timing work in our favor. All right. When it comes to an active trade, this is oftentimes based off of an hourly chart, and we're using 3 to 10 day options for our active trades. In many cases, I'm in and out in just a couple of days. I'm willing to trade those shorter term options. They're going to be a little bit more time sensitive. I want to make sure I've got a high confidence level that the stock is going to do what I want it to do pretty quickly. The time decay can help us on these trades, can help provide more forgiveness. And in many cases, it has us either looking at the current week's options or out the next week. If you're trading a tech stock or an index product that also has Monday, Wednesday expirations, those are fine too. But in many cases, we're in that 3 to 10 day window. For the day trades, oftentimes those trades are based off of a 5-minute chart. Could go all the way out to an hourly chart. But for us, on our side, we base our day trades off of a 5-minute time frame. And we're utilizing options that have between 1 and 3 days left to expiration, just depending on the product that you're looking at. Right? You could use a 0 DTE option. You could use, if it's an individual stock, you might go out a couple of days depending on what cycles are available. But these are the most time-sensitive trades you can take. Right? You have to have a very high confidence level that the stock is going to either remain very active and move in your favor or stay in a very choppy sideways range. You don't have the benefit of being patient all that long on these types of trades, right? So I'm not saying you should strictly trade swing positions or active positions. I'd like to use a combination of all 3 of these. I just want to make sure my outlook and the time frame that I'm using on the chart matches up with the way that I'm structuring my spreads. And this is the framework that we use for the expirations. When it comes to the strike prices that we choose, this really comes down to how much premium is available to us. A big mistake that traders make is they go very deep out of the money. And the thought process there is if you go out to a deep out of the money option, you have a very high probability of success. Right? Chances are you're going to win on a majority of your trades. The problem is if you don't collect enough premium, all it takes is one trade to lose and it's wiped out all of your winners and then some. I'm okay risking between 2 and 3 to make one. I'm not okay risking 5, 6, or 7 to make one because if I do that, it puts a tremendous amount of pressure on the winning percentage. So I've listed 5 common spreads that we use on our side. And I've listed the minimum that we like to collect on these spreads. So it's going to be a balance of premium collected. I want to collect enough to leave us in that risk 2 or 3 to make 1 range. And I also want to make sure that I'm collecting enough on a tight spread to make it worth my while. All right. So on a dollar wide spread, when I say a dollar wide, I'm talking about the difference between the strikes. All right, so if it's a dollar wide spread, I want to collect 35 cents or higher. If it's a $2 wide spread, I like to collect 50 cents or higher. On a $2.50 wide spread, 60 cents or higher is the minimum there. A $5 wide spread, $1.25 or higher. And then the $10 wide spread, $2.50 or higher. I don't care if it's a dollar wide spread or a $10 wide spread, the criteria remains the same. If you've got a smaller account, you're going to most likely lean towards the $1, $2, or $2.50 wide spreads. It's going to tie up less capital. It's going to leave you in a safer position. As you start to grow that account, you get more experience. The $5 and $10 wide spreads can be great trades as well. So don't lock into just one of these. I use all 5 of these on a fairly frequent basis. Now, trade management, also a big stumbling block for a lot of people. When you open up a credit spread, whatever you collect to open up the trade is your maximum profit potential. But the only way you can keep that entire premium is if you hold all the way up to expiration. We don't typically do that. We like to close the trades out early, take a partial profit, free up the capital, and move on to the next trade. Redeploy that capital in something new that's going to give me a bigger profit potential. The way that we use our targets, we like to target 50% of our max profit. All I'm simply doing there is taking my entry price, dividing it in half, and that is my target level on that specific spread. And I can get that closing order working right away as soon as I open the position, set that trade to a GTC or a good till cancel. That way it's in place, takes the pressure off needing to monitor it all day long. You can also stretch it out and go to 75% of max profit. I'm okay with that as well. I'll typically do that in a market that's giving us more trending type moves, more follow through. So you can certainly stretch those targets out if you wanted to. I just don't like to hold the expiration. Keep in mind, the closer you get to expiration, yes, the time decay picks up, but so too does the gamma. And the gamma tells you how quickly those options are going to react to changes in stock price. And I have had it in the past, where I try to hold the expiration, the trade is profitable for days on end, and then on expiration day, we get a reversal against us, and the trade goes back to a loss. Just don't want to let that happen. I'd rather take my profit early, free up the capital, move on to the next trade. And with commissions so cheap these days, you're really not saving much on the commission side to hold all the way up to expiration. Now, what happens if a trade goes against us? Let's talk about the stop side. We recommend using a 70% stop. So when the trade is down 70% of the max risk on the trade, we would go ahead and close out of the position. That way we're not taking a full loss on every trade that goes against us. So all you would do there to get your stop price, take your max risk on the trade, multiply it by 0.7. You're just taking 70% of that value. Take that number and add in your entry credit to get your stop price. Simple as that. As soon as you have that number, you could get the closing order working right away if you wanted to. Set it to a GTC or a good till cancel order. That way your orders are in for target and stop, and those orders remain active until they get filled or until you manually come in and cancel them. Now let's put this into motion and take a look at a recent example of a trade that we took with our members. This is what we call our Mag 7 Options Edge. This is a very active program using credit spreads off of an hourly chart. Typical holding time for us is 2 days, meaning we're going to utilize those 3 to 10 day options in many cases. This is an hourly chart of Meta. And if I take a look here, you'll see I have my red dot indicating price is starting to roll over to the downside. Right? We see our pulse indicator down at the bottom. We're seeing a series of lower lows on the pulse. We get price to break through our EMA up top, which is the white line. It's giving us a bearish outlook because energy was starting to build and it's starting to be released on the downside. I want to lean into the bearish side, but I don't want to be overly aggressive. If I come in and buy a long put, I only have one way of making money. That stock would have to move to the downside, and off of the hourly chart, it would have to move to the downside quickly. Instead, we went to the call credit spread. And specifically, we sold the 675, 677.5 call credit spread. We collected $74 per spread, tied up $176 of our capital per spread, and all I'm doing there is selling the 675 call, buying the 677.5 call at the same time to define our risk. It's not overly advanced. You're not tying up more capital. If you were to compare this to buying a long put, the long put on Meta is potentially going to cost you a couple $1,000s. We're tying up $176 of our capital. That's our max risk. If you do have a bigger account, you can simply just adjust your position size. Right? You take this with 10 spreads, you're looking at just over $1,700 of capital being used. So you can certainly adjust position size accordingly. You can trade as small or as big as you want, just depending on the capital you have available. Now, putting this trade on, I made money if the stock moved up, down, or sideways. As long as price stayed below 675, I was okay. I made money from the time decay adding up and from the volatility decreasing. Any combination of those 5 would work for me. Okay, because this is an hourly chart, we're using 3 to 10 day options. On this one here, we had, I believe, 6 days left to expiration. So I'm looking to predict what's going to happen over the next couple of days. Not concerned with what's going to happen 2 months from now. We'll cross that bridge when we get to it. I'm basing my decision off of the hourly chart. I'm using a 6-day option here. Now all of a sudden, my trade matches up with my outlook in the time frame that I'm using on the chart. Thankfully, we did get a move to the downside. It wasn't anything earth-shattering. It wasn't a market crash, but we didn't need it to be. We ended up closing this position out for 27 cents. It gave us a $47 profit per spread, 27% return on our capital. And again, we're in and out on these trades 2 days on average. So now I'm booking a 27% return in a couple of days, free up that capital, move on to the next trade. You take a couple of these active trades a week, it adds up very quickly. And again, with $176 at risk, you're not looking at needing a 6-figure account. You can do this with a very small account and the numbers start to work out in your favor very quickly. Now, here's what it looks like long term with this specific trade. Here's why the credit spreads work out so well. Because we're stacking the deck in our favor. Yes, we're looking at, in many cases, a 20, 25% return on our capital. Are you looking for a home run trade? Are you looking to double your money on every trade? No, we're not. But here's what starts to get fun. Over the last 200 trades that we've taken with this approach off of the hourly chart with our Mag 7 trades, we have over an 85% win rate. Right? I can trade that with a high level of confidence because I know the numbers are in my favor. The long calls and long puts, when they work, can provide a bigger return, but you're going to have a much lower probability of success. I know most retail traders, they love the thought of booking the home run trades. And again, I'm not telling you don't ever go for those bigger returns, but you also want to make sure you have these types of trades on. These are the trades that are my plow horse. I know if I'm winning 85% of all the trades that I take, that's a reliable source of income. With the long calls, long puts, that's a much smaller part of my portfolio. When they work, that's a great bonus. And now I get the best of both worlds. So on these trades here, 24% return on average on the winning side, 45% on the loss side. Very good ratio for a credit spread. We're always going to be risking more to make less, and we're okay with that because we have 5 ways of making money on every trade. Average time in the trade, 2 days. And you can see this equity curve has just, since the beginning of the year, just continued to push higher. Right? If you have a long call and long put portfolio, you're most likely looking at an equity curve that's like this. Move forward, big step back. Move forward, big step back. This right here, for a good portion of my portfolio, is easier for me to handle because I know it's more predictable, it's more reliable, it's more consistent. And that's a big part of what I do. All right, so that's how I structure my credit spreads. Hope you find that beneficial. If you wouldn't mind, subscribe to the channel. It's a really big help for us. If you have specific questions on credit spreads, or if you'd like us to cover any other topics specific to your options trading, let us know. Leave a comment on the video. We're more than willing to get out some additional resources to you guys on those topics. And we do have a link in the description of the video for some additional resources on how we trade options at NetPicks. So visit that link and we'll get you those resources right away. All right, so I'm going to wrap this video up here. We'll be back with you guys over the next few days with our next video.